Welcome back to Investing with Mackie. Today we're uncovering the mysteries of theta, a critical concept in option trading known as time decay. If, like me, when you first started trading options, you would open a position by buying a contract. You waited for your big play to pan out, and the value of your option kept getting smaller and smaller. In this chart, a link below in the description, each line represents a strike price. We can see that the further you go into the future, the more expensive option contracts are. Trying to maximize profits by reducing cost, maybe you bought contracts close to expiration on the left side of the chart. As we can see, 1 to 2 weeks out, our 470 strike is, say, $500 to $600 per contract. These options are a lot cheaper than, say, 6 months out. We set our scale, looking at maybe around June, that 470 contract is $2,400. So after helplessly watching options expire worthless, you decide you need more time. Instead of rebuying that same option every week or two, you realize maybe further out expirations might actually be worth it. It turns out this change in price is a measured value that is a pivotal factor in pricing of option contracts. Because you're watching this video, you know that we're talking about the Greek theta. For the definition, theta represents the rate at which an option's value declines as time passes, assuming all other factors remain constant. As each day passes, options get closer to their expiration date. Theta gives us an estimate of how much value an option will lose with each of those passing days. As we can see here, time decay is not linear. Theta accelerates as an option approaches its expiration, affecting out of the money and at the money options the most. Theta decay starts to eat into that extrinsic value of the option, which out of the money and at the money options tend to have more of. Once again, taking a look at that 470 strike, we can see, we'll zoom in on that, say 6 months out, that 470 is about 8.2 cents per share of the contract per day, which is pretty close to the 465 and the 485. But as we get closer and closer to expiration, we can see that that 470 jumps all the way down to 40 cents per day. Right? That's nearly 5 times the decay in that option. For buyers, a high theta reduces potential profits as the option nears expiration. For sellers, this can be your friend, potentially eroding the option's value and making it cheaper to buy back that position. Short-term options typically have a higher theta, as we just saw, than long-term ones. Traders need to be mindful of this, especially when holding positions close to expiration. Theta is a key player in various trading strategies, especially those involving this time decay, like simple vertical spreads, iron condors, or calendar spreads. Those executing theta decay strategies are sometimes considered the theta gang. There's actually a whole subreddit devoted to discussing these strategies. To recap, theta represents the rate of time decay of an option's price. Theta has a higher impact on short-term options and is a critical factor that should be considered especially for options near expiration. And that's theta demystified. Make sure you subscribe to Investing with Mackie for more insight into option trading. Drop your questions and topics you'd like us to explore in the comments below. Happy trading.